Hi, so the next few minutes could save your portfolio. There are three big news happening right now, and professional traders are already positioning for these. So keep watching to learn what those are. So bonds are finally worth buying again. For the first time in over a year, bonds have great upside potential. So if interest rates drop, you could gain 10%. And if they rise, you only lose about 1%. And those are fantastic odds. So here's what the smart money is doing. Stanley Druckenmiller, a legendary investor, is betting against long-term bonds, but buying short-term bonds. And this is an interesting play on interest rates. And he's betting 25% of his worth on this. But here's the hidden danger. Hedge funds have 1 to 2 trillion in risky bonds. And these are highly leveraged bets which could blow up at some point, resulting in a situation like the 2020 crash, but worse. So here's what you could do. You could buy bonds or, for example, also copy Druckenmiller's play. And remember, no financial advice. And of course, who hasn't heard about it yet? The Fed chair drama that could rock markets. So the Fed chair Jerome Powell technically still has 1 year left on his job, but Trump and his team are already looking for a successor. And this, of course, leads to a lot of uncertainty about the rates that the Fed will do. So here's why this matters. On the one hand, Trump wants tariffs, which usually increase inflation. But on the other hand, he also wants to aggressively cut interest rates, which also increases inflation. So these two things basically work against each other. And this causes a lot of uncertainty, which, of course, the markets hate. So here's what institutions are, or should be, doing. They're buying gold and inflation-protected bonds, and they're betting on market volatility, or capitalizing on the increased number of trading opportunities caused by market volatility. Because uncertainty about monetary policy always, of course, leads to more volatility. And now it's time for a little history lesson, because when everybody's buying, it's actually time to worry. So cash balances for professional fund managers are at a very low level, about 3.9%. And this is the lowest in 12 years. And what usually happens when people are all in on stocks is they're about to fall. So when everyone's all in, there's no one left to buy, of course. And stock levels right now are at a similar level as they were at the dot-com bubble. And of course, we know how that ended when the bubble popped. And that should be a history lesson to us. And here are the early warning signs. So Indian tech stocks are getting crushed right now. They're 14% down for this year. Companies like Infosys and TCS handle tech work for global companies. And when they struggle, it just signals that the demand overall for tech companies is down. And this could, of course, spread to US tech stocks. And the smart, but probably also just more safe move is to move from quick growth tech stocks to safer value stocks. And I wouldn't wait until everyone else figures this out. So here are the three takeaways. Bonds are finally attractive again, but watch for the hidden risks. Regarding the Fed policy, you should protect against inflation, perhaps with gold or other inflation hedges. And with stocks, maybe it's a good idea to move away from expensive tech stocks and move into value stocks. So here's the bottom line. The smart money institutions is or should be already doing these things. So if you want to do any of these things, you should do them before the rest of the crowd does. And of course, always remember to do your own research and not financial advice. And if you're an institutional investor looking for a safe haven for your assets, head to autotradelab.com and let's have a chat. Otherwise, thank you for watching. Smash that like button, hit the subscribe button and the bell, and comment down below what you want me to cover in the next video. And thanks for watching.